Would you like to be invested in a business that is experiencing a surge in growth? Want a safe dividend that beats the market and is growing at a double-digit rate? Looking for a great deal on a great stock after it's fallen by nearly 30%? Then you have to check out today's video.
He is a best-selling author.
30-year-old Jason Fieber has a plan.
This guy retired at only 33 years old.
I don't know if I know too many people that have accomplished something like that.
He's really kind of a guru when it comes to passive income.
Before I get into today's content, please give us a big thumbs up if you find value in our videos. Helps us to get the word out and grow the channel, and I'd really appreciate it. And make sure to stay tuned until the end of the video for a special news announcement. I want to tell you about a high quality stock that pays big, growing, reliable dividends. These growing dividends are funded by growing profit because this business is a leading technology firm. 5G, IoT, AI, AR, VR, self-driving autos. These are the areas of tech you want to be in. Well, this company is exposed to all of them, and it's growing like crazy because of it. Revenue is growing like crazy, profit is growing like crazy, and the dividend is growing like crazy. I personally invested in stocks just like this one on my way to going from below broke at age 27 to financially free at 33. By the way, I explain exactly how I achieved financial freedom in just 6 years in my early retirement blueprint. If you're interested, you can download a free copy of my early retirement blueprint using the link in the description of this video. Getting back to the stock I'll tell you about today though, perhaps best of all, it looks undervalued right now. Price is what you pay, but value is what you get. Why is that important? Because buying a dividend growth stock when it's undervalued should provide for a higher yield, greater long-term total return potential, and reduced risk. With this in mind, I want to share with you an opportunity I recently came across in shares of Qualcomm Inc., which appear to be trading at a significant discount today. Qualcomm Inc., stock ticker QCOM, is a multinational technology corporation that creates semiconductors, software, and services related to wireless technology and connectivity. Founded in 1985, Qualcomm is now a $151 billion by market cap tech giant that employs 45,000 people. The company reports results across two business segments: Qualcomm CDMA Technologies, or QCT, 80% of fiscal year 2021 revenue, and Qualcomm Technology Licensing, or QTL, 19%. The world is becoming more reliant on technology in general. In particular, wireless technologies based around connectivity are becoming critical to everyday life. A digital transformation is playing out. This was true before the pandemic hit, but it's even more true now with a greater number of people working remotely. This digital transformation started with the smartphone revolution. Well, Qualcomm has long been a leader in the wireless space, and the company holds virtually all essential patents used in 3G, 4G, and 5G networks. Because of this, Qualcomm collects royalty income on the majority of 3G, 4G, and 5G handsets sold worldwide. A very lucrative start, but the smartphone revolution has been evolving into the Internet of Things, where everything from your watch to your refrigerator can and will communicate with one another. This benefits Qualcomm to an even greater degree. The company had the foresight to parlay their early IP success into a diversified business model that offers a suite of technologies and services across an entire IoT ecosystem. The company is now exposed to some of the biggest and most enduring trends in all of technology. We're talking about 5G, broadband, modern RF systems, gaming, IoT, self-driving autos, AI, and AR/VR. Unless society suddenly does a giant U-turn back toward the Stone Age, Qualcomm is poised to continue benefiting to ever greater degrees from the continued shift toward the digital transformation. And that should mean growth in the company's revenue, profit, and dividend for many years into the future. As it sits, Qualcomm has increased its dividend for 20 consecutive years. That's actually an impressive dividend growth track record considering the industry and business model. 20 years is a lifetime in tech. The 10-year dividend growth rate is 12.5%, which is also impressive. Now, the dividend raises have been a bit lumpy, but a lot of that comes down to certain idiosyncratic factors such as long-standing legal issues. With these issues largely cleared up, however, I suspect that future dividend raises will be more consistent in size. Also, the stock offers an appealing yield of 2.2%. That yield easily beats the market, and it's not terribly far off from the stock's own 5-year average yield. And the payout ratio is at only 30.7%. This well-covered dividend is positioned for a lot more growth. I really like these dividend metrics. Looking at business growth, Qualcomm increased its revenue from $19.1 billion in fiscal year 2012 to $33.6 billion in fiscal year 2021. That's a compound annual growth rate of 6.5%. I usually look for a mid-single digit top-line growth rate from a mature company like this. They more than delivered here. Meanwhile, earnings per share moved up from $3.51 to $7.87 over this period, which is a compound annual growth rate of 9.4%. Strong bottom line growth here. What I really like about it is there's been a recent acceleration in earnings per share growth after a multi-year period of languishing. Almost all of this growth has occurred over just the last few years. I think the surge is sustainable. Looking forward, CFRA believes that Qualcomm will compound its earnings per share at an annual rate of 19% over the next 3 years. This builds on what I was just outlining. Qualcomm could be in the early innings of a growth speed up, which is the result of a thoughtful transformation across the business. Whereas Qualcomm was mainly a handset IP play a decade ago, the company has broadened itself out into areas like auto and IoT. The company took a solid foundation and built something even bigger and better on top of it. Indeed, the recent Q2 fiscal year 2022 earnings report showed 40.7% year-over-year revenue growth and 68% year-over-year earnings per share growth. Jaw-dropping numbers here. Speaking on the legacy aspect of the business, Qualcomm has long been a leader in the Android space. However, the company has two additional tailwinds in that space. First, even more market share. CFRA notes that it believes Qualcomm, and I quote, has been able to take share in the Android ecosystem given Huawei's chip manufacturing limitations, unquote. Second, 5G. CFRA states this, and I quote, "We believe Qualcomm is benefiting from 5G adoption given its offerings span baseband, transceiver, RF front end, and antennas," unquote. Then there's the diversification. Qualcomm states that its auto pipeline is now at $16 billion, and CFRA states this about the company's opportunities in IoT, and I quote, "We see IoT growing at a 3-year compound annual growth rate of 17%, led by the metaverse and edge networking, among other verticals," unquote. Qualcomm was a really good business a decade ago. I think it's a far better business today with less reliance on handsets and more growth promise. It appears to be positioned for easy double-digit dividend growth for the foreseeable future, which would come on top of the market-beating yield. I see a lot to like about that combination of yield and growth. Moving over to the balance sheet, the company has a rock-solid financial position. The long-term debt-to-equity ratio is 1.4, while the interest coverage ratio is over 24. Profitability is also quite robust. Over the last 5 years, the firm has averaged annual net margin of 11.8% and annual return on equity of 64.2%. Both numbers look lower than they ought to. Fiscal year 2018 was an anomaly that reduces average profitability over the last 5 years. Net margin, for instance, came in at nearly 27% for the last fiscal year. I think Qualcomm is a great business that looks greater than it ever has before, and it does benefit from durable competitive advantages that include IP, R&D, economies of scale, pricing power, and switching costs. Of course, there are risks to consider. Regulation, litigation, and competition are omnipresent risks in every industry. Litigation has been an especially thorny issue for Qualcomm. Qualcomm has a near monopoly on CDMA technology patents. These valuable patents and the lucrative royalty fees they generate have led to legal battles worldwide. Many cases have been settled, but this will likely be a persistent risk for years to come. The very business model is a risk unto itself. Technology is constantly evolving, and this is happening at an ever faster speed. Qualcomm will have to keep up with the changes in order to remain competitive. Handset makers have been vertically integrating. This threatens Qualcomm's handset chip business. A number of Qualcomm's end markets are still novel. Questions remain about their long-term prospects. I think it's important to carefully consider the risks here, but I also think Qualcomm's overall quality and appeal transcends the risks. And after a 28% drop from its 52-week high, the stock's current valuation makes it that much more appealing. The stock is trading hands for a PE ratio of 14.3. That's quite a bit lower than the broader market's earnings multiple. It's also substantially lower than the stock's own 5-year average price-earnings ratio of 27.2. Now, earnings per share has not been super consistent over the last few years, making the comparison difficult. Still, scoring a lower multiple when growth is higher strikes me as opportunistic, and the yield, as noted earlier, is not far off from its own recent historical average. I valued shares using a dividend discount model analysis. I factored in a 10% discount rate and a long-term dividend growth rate of 8%. This dividend growth rate is at the very top end of what I allow for. If there's any company that deserves it, it's Qualcomm. Both their short-term and long-term earnings per share and dividend growth have been outstanding, and CFRA's near-term EPS growth expectation is more than twice as high as this number. Plus, the payout ratio is low. I think it's likely that Qualcomm will actually exceed this 8% dividend growth rate over the next few years. On the other hand, it would be prudent to assume a moderation over the long haul. The dividend discount model analysis gives me a fair value of $162. The reason I use the dividend discount model analysis is because a business is ultimately equal to the sum of all the future cash flow it can provide. The dividend discount model analysis is a tailored version of the discounted cash flow model analysis, as it simply substitutes dividends and dividend growth for cash flow and growth. It then discounts those future dividends back to the present day to account for the time value of money, since $1 tomorrow is not worth the same amount as $1 today. I find it to be a fairly accurate way to value dividend growth stocks. Morningstar rates Qualcomm as a 4-star stock with a fair value estimate of $163. CFRA rates Qualcomm as a 3-star hold with a 12-month target price of $160. We have an extremely tight consensus this time around. Averaging the three numbers out gives us a final valuation of $161.67, which would indicate the stock is possibly 16% undervalued. Here's the bottom line, guys. Qualcomm Inc. is a high-quality company that's arguably never looked better. A transformation of the business has led to exciting new verticals and more growth. With a market-beating yield, double-digit dividend growth, a low payout ratio, 20 consecutive years of dividend increases, and the potential that shares are 16% undervalued, dividend growth investors would be wise to consider answering the door while opportunity is knocking. And now for a special news announcement. Lockheed Martin Corporation, stock ticker LMT, keeps racking up the contracts. It was announced on May 17th that the company landed a $632 million Naval Air Command contract. That followed up numerous multi-million-dollar contracts announced in the days prior. Lockheed Martin is one of my top 5 stocks for 2022. The stock is up 22% year to date, but the consistent contract flow should continue to support the business and the stock moving forward. If you don't yet have this long-term winner in your portfolio, look for any chance to change that. Thanks so much for watching. I hope you enjoyed today's video. Give us a like if you did, and let us know in the comments what you think about this stock. Please make sure to subscribe to the channel and ring that notification bell so you don't miss out on new content. Also take a look at the description box below for some important links, including a link to my personal stock portfolio. This 6-figure portfolio, which I call the Fire Fund, generates enough passive dividend income for me to live off of. It allowed me to retire in my early 30s. I've made my portfolio entirely accessible over at Patreon, and I also post alerts there whenever I buy or sell a stock. I put my money where my mouth is, and I'm often invested in the same high-quality dividend growth stocks that I make videos on. Over the years, I've heard from thousands of investors who've been profiting from many of the same exact stocks that I own. So if you think this is something that you could benefit from as well, check the link in the description to see my portfolio and start getting my buy and sell alerts. I'll see you next time.